Hey guys, welcome to the 7th session of FinBites in the Basics of Stock Market series. This video is sponsored by TradeManza. Check out the link in the description to know more. So guys, there's a little disclaimer here. We are not SEBI registered financial advisors. Any information provided in whatsoever fashion is for the general sake of education and should not be taken as a financial advice or investment idea. So we'll learn about the basics of fundamental analysis and financial ratios in this video. Okay. So yes. So what are financial ratios? These are numbers which quantify the performance of a company. It helps us in interpreting the results, and they are basically calculated by using the data from the financial statement of the company. That is, we use balance sheet and other financial statements to actually calculate these financial ratios. We compare them with different companies in the same sector. So basically, they speak about the companies, and we can compare the company with the competitors in the same sector by using financial ratios. So moving forward, how can I get these ratios? So definitely it's a very tedious work to go to the balance sheet and then calculate these financial ratios. So we have screener.in. So we can get these financial ratios from screener.in. Okay. So this is screener.in. So this is Bajaj Consumer Care. And scroll down, we can find all these ratios here. If you want, we can edit these columns and add more ratios if needed. So yes. So what are the types of financial ratios? Okay, so guys, these terms might seem pretty difficult towards the beginning, but believe me, if you're able to understand these ratios and if you're able to understand these formulas rather than by hearting it, then it's actually very simple. So first, profitability ratios. What is profitability ratio? It measures profitability. Okay. Next is leverage ratio. Leverage ratio means how much the company is using debt to sustain its operations, and valuation ratios is basically whether the company is undervalued or overvalued in the current market. Okay, so yes, the first one is ROE. ROE comes under profitability ratio, and this is return on equity. Okay, so ROE shows the efficiency of the company in terms of generating profits to its shareholders. Okay, so this ratio indicates how much money shareholders make on their investment in the business firm. So this is a formula, guys: net profit by shareholders equity into 100. Okay, so this is a net profit and divided by the shareholders equity into 100. So let's just analyze this formula. If the ROE is 53.7%, here it means that the company makes a net income of rupees 53.7 using shareholders investment of rupees 100. Okay, if the denominator is 100 and the numerator is 53.7, just analyze it in that way. So if it is 53.7%, it means that the company makes a net income of rupees 53.7 using shareholders investment of rupees 100. So let's just go to Bajaj Consumer Care. Yes, so ROE. The ROE of Bajaj Consumer is 32.73%. This means that the company is making 32.7 rupees using shareholders investment of rupees 100. Okay, so that is ROE. Guys, it is very important for us to analyze this formula rather than by hearting it. Okay, let's go to the next ratio. Next ratio is ROCE, that is return on capital employed. It once again is a measure of the company's ability to generate profit from its total capital. Okay, so unlike ROE, the difference here is in the denominator we are using the total capital employed. Looking at this denominator, it is just shareholders equity, whereas in this denominator we will use equity plus debt, so it is a total capital employed. A good ROC usually means that debt and equity, that is the total capital, is put to good use. Okay, if ROC is high, company is making more than the cost of borrowing. Okay, so if ROC is 67.4%, this means that the company makes EBIT, that is earning before interest and tax, of rupees 67.41 using capital of rupees 100. Okay, so let's just go to again screener.in. Bajaj Consumer, ROC of 39.04%. That means for every rupees 100 of shareholders investment, the company is able to generate a net revenue of rupees 39.04. Okay, now let's move to the yes. So ROCE versus ROE. Guys, ROE and ROCE both are pretty similar. Just that if you look into the denominator of both these formula, that is in ROE we use just equity, whereas in ROCE it's equity plus debt. Okay. So there shouldn't be a large divergence in ROE and ROCE, as it shows your debt investors are more profitable than equity investors. Okay. So here what it means that ROE and ROC, there shouldn't be a large divergence here. It is always good if your ROC and ROE is close, And also if your ROCE is greater than ROE. Okay, if your ROCE is greater than ROE, this means the company has very less debt or no debt. Okay, both ROE and ROCE should be above 20 for a great company. Okay, so that is about ROCE and ROE. Guys, we cannot just analyze a company based on just a single ratio. It is always good to use more than one ratios to analyze the company. Okay. Now next is ROA, that is return on assets. The formula here is net income by total asset into 100. It is usually used for banks and financial companies. Okay. And yes, let's just analyze this formula once again. If the ROA is 49.81%, this means that the company can generate a net income of rupees 49.8 using assets worth of rupees 100. I hope you got this. That is, for example, if this ratio is 49.8, okay, this means the company can generate an income of 49.8 using assets worth rupees 100. Okay. Once again, let's just go to screener.in ROA. See, ROA is 31.47%. It's pretty high because it's not any bank, it's an FMCG. 31.47% ROA for Bajaj consumers. So these are the three ratios under profitability ratios. Now let's go to the next section, that is leverage ratio. As I told before, leverage ratio is basically used to identify whether the company is running with its debt or whether it's using its borrowings efficiently. Okay. So again, debt to equity ratio, it is a ratio of long-term liabilities by total equity. So higher the ratio, it is actually a red flag because we definitely don't want the company to have higher borrowings. If it's using it for an expansion or any other purpose, then it's good. But otherwise, a low debt to equity ratio is something that is formidable. Okay, so a value of 1 in the ratio indicates an equal amount of debt and equity capital. So look into the formula: long-term liabilities by total equity. If the value is 1, it means that the liability and equity both are same. But a value less than 1 is something that's formidable. So let's just go into the, yes, debt to equity ratio for Bajaj consumer is 0.02. This means that the company is almost debt free. That's what the DE ratio indicates. Okay. Now moving forward, the next one is current ratio. The ratio of current assets by current liabilities. It measures the company's ability to service short-term obligations. A good current ratio is between 1.5 to 2. So screener.in, guys, actually current ratio is not there in screener.in, so we'll actually have to go to balance sheet and then find the value. Okay. Next is interest coverage ratio, that is ICR. The interest coverage ratio measures how many times a company can cover its current interest payment with its available earnings. The formula is EBIT divided by interest payment. Okay, EBIT is basically earning before interest and tax. So once again, let's just understand this formula. If ICR is 125x, so basically it is not in terms of percentage, it's like a multiple. This means that for every rupees of interest payment, the company is able to make rupees 125, which is a very good value. Okay, that means for every 1 rupee of interest that is paid by the company is able to make or generate profit of rupees 125. And interest coverage ratio for Bajaj consumer is 79.06. So guys, what does this indicate? For every 1 rupee interest that is paid by Bajaj consumer, it is able to generate an income of 79 rupees. Once again, when we compare this to all the competitors, it is a very good value, 79.06. Okay. Yes. Now the next one is valuation ratio. Okay, so valuation ratio, as I told before, it shows whether the company is undervalued or overvalued in the current market scenario. Guys, one important point with all these financial ratios is that it doesn't convey anything when standing alone. We always have to compare it with either the competing companies or the previous ratios of the same company. So here we have the peer comparison here. So we'll always have to compare all these ratios with all these competitors. Okay. So now P ratio, once again, it is price to earning ratio. That is current market price divided by earnings per share. It compares the present market value of the company to the earnings per share of the company. Okay. If the P is 29, this means for every unit of profit generated by the company, the market participants are willing to pay 29 rupees to acquire the share. Okay. Typically, low PE ratios mean the company is undervalued, but sometimes it may also indicate that there are flaws in the fundamentals. Okay. So once again, PE ratio, we'll always have to compare PE ratio with the industry PE value as well as the competitors. Let's look into Bajaj Consumers. The value is 18.08. Compare it with all the competitors, it is pretty low. Also, it is also low compared to the industry PE value, which means Bajaj Consumer right now is undervalued by the market participants, and it is a good time to buy the stock. Once again, this is just about PE value. We'll also have to look into other ratios before coming to a conclusion. Yes, compare PE ratios within the sector. If a company is not profitable or takes time to get profitable, like insurance company and telecom company, then we look at PB ratio. PS ratio is also used at times. PS ratio is nothing but price to sales ratio. Okay. Yes. So price to book ratio, guys. So price to book ratio, it compares the market value to the book value. So book value, actually, what is book value? Okay, suppose I have a company, and if I'm selling all the assets of the company and I'm paying all the borrowings and everything, the value that remains with me is the book value of the company. So the formula here is current market price divided by book value per share. A high ratio indicates that the company is overvalued, whereas low ratio indicates company is undervalued. So once again, getting back to screener here, yeah, current market price by book value. Okay. Let's look at Bajaj Consumer 4.52 and the industry PB value is 4.41. So let's just compare this with the competitors. It is definitely less. Industry PBV, once again, not much of a difference. So definitely Bajaj Consumer is something that is undervalued in the current market scenario. But once again, guys, we cannot just take a call just based on two ratios. We'll have to look into the entire ratio and the performance of the company before taking a call. So this is about the fundamental analysis and financial ratios. I hope you got this. Pretty simple, but it is always important for us to kind of understand what these ratios are rather than simply by hitting the formula. So that's it, guys. Thank you.